Over the next few weeks, we have some very large companies that are reporting their earnings, and in today's episode, we are taking a look at 5 stocks that we will be adding to the portfolio if we do get a market overreaction. Now, the first one is Visa, a fantastic company as we are about to show. Currently, it does get a double buy rating with a hold from Quant and has had a pullback in recent period. In fact, right now sitting towards the midpoint of the 52-week range. Forward yield sits at 0.78% and the forward P just below 27. Bear in mind, S&P around 23. Over the last year, it's up around 10%, and when you look over the last 10 years, it has significantly outperformed the S&P, up around 384%. Now, in terms of dividend safety, no surprises that it gets the ultimate high score of 99. And when we do take a look at their dividend growth, very typical with this company, they do tend to increase that dividend at double digits on a consistent basis. And no surprises whatsoever. In fact, their dividend safety score was reaffirmed to be very safe, meaning a dividend cut is highly unlikely. Now, how did they perform in the last recession? Well, in fact, they increased the dividend during the 07-09 Great Recession. They had plus 10% sales, well above the average. Bear in mind the S&P during 07-09 was around negative 12. As we mentioned, very large increases to their dividend, double digit over the last 5 years, as well as double digit increase over the last 10. On top of that, they have been increasing those dividends for the last 15 years. Now, when we move on to dividend yield theory, for those that are new, it essentially shows us a company is undervalued when the current yield sits above the 5-year average. So not only do we have an undervaluation signal on the yield, but we also see one on the forward P, 25.4, that is lower than the 5-year rolling of 28.9. However, we do note the financials as a whole, as a sector, 11.8, much lower. But as always, you could argue a lot of lower quality companies within this basket. We then move on to the free cash flow payout. Below 60% is what we want to see for the majority of companies, and we can clearly see that year on year, in fact, pretty much below 30%, 20% expected over the next full year. No surprises then how they can offer those double-digit increases. We then move on to the free cash flow with this company. Absolutely gorgeous. As always, we want consistent increases over the longer term. That is pretty much what we get to a degree, and we can see over the next 12 months that increase is expected to continue. On top of that, 3 to 7% growth top line for every single company we look at, nearly double digit every single year for Visa, although we do note that COVID year justifiable drop of 5%. In terms of the numericals, well, we can see, in fact, nearly tripled their top line over the last 10 years. And what we also quite like for this company, as an added bonus, they do return that excess cash to shareholder pockets through those share buybacks, which they pretty much do consistently year on year. Then we look at the ROIC, one of the most important metrics. Around 10% or more is what we want to see year on year. Give us faith, management are able to effectively allocate their capital. Incredibly strong over the last 10 years for Visa. 34% in the more recent year does make it very, very strong for those that are considering adding. That is a phenomenal metric. We then move on to the operating margin, not only above the minimum 12%, extremely high, very consistent and increasing over the longer term. Same to be said for the free cash flow margin, very, very strong. These are some very large numbers that is not typical of companies, especially in the S&P. We then take a look at the net debt to EBITDA. The reason why we look at this, the earnings before interest, tax, depreciation, amortization, it relates to dividend safety as well, and more importantly, in fact, to the balance sheet strength. So we want to see below 3, which is the rate that we're looking at throughout today. And these numbers below that you see the number of years it would take the company to pay off all of their debt net of cash on hand. 0.05 in 2023, 0.1 over the next 12 months. This goes to show this company has an incredible balance sheet, and that dividend, as we saw, 99, the highest score obtainable. We then move on to the valuation. As always, if you do enjoy the content, values being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. In our deep dives, we do run through every single one of these models. Today's episode, we're getting straight to the intrinsic value, $323. Now, the current price sits at $265, and as always, we do add an MOS level, 10%, which we execute on if we believe it meets our 3 golden criteria: wide moat, strong financial metrics, good forward-looking data. If you believe that, well, today it's a buy at $291. Then we keep going till it's near the current trading price, and we can see in today's episode, not at a 20% MOS level just yet, sitting at around 15%. Now, in my opinion, this is a very high quality company. This is one that I will personally start to add around that 20% level. So if it does come around the 258, in fact, if we're lucky enough to see it around 242 to 258, then this, in my opinion, is a must buy. And I will be adding, as we said, we will keep an eye on earnings and see if there is an overreaction or just a general downtrend throughout this earnings. In terms of Wall Street, well, they see some nice upside even at that current price, $317. And as we said in today's episode, you are getting at least a 15% margin of safety. As always, as we go through, do let us know your thoughts below. Now, before we move on to the next stock, just to let you know, we have released our latest free weekly article. This article, in fact, comes with a free spreadsheet running through all the undervalued dividend kings and our buy prices. If you click on below, sign up, you also get instant free access to all of these other articles. Now, the next stock, the reason why we're including this, very similar to Visa. A lot of people have requested to see side by side how they compare. So we're just going to add this. Likewise, if we see weakness, overreaction, this will also be one we will add to the portfolio. Over the last year, we're up around 10%. Over the last 10 years, up 463. So again, another significant outperformer of the S&P. Also, bear in mind, this doesn't include dividends reinvested. So if you do, it will be marginally higher. Similar to Visa, trading towards the midpoint of the 52-week range. Again, another double buy and a hold. Forward yield, 0.6%, so marginally lower than Visa. And it does have a marginally higher forward P at 30.83. Now, similarly, it has a 99 very safe dividend score. And again, they both increase their dividends at double digits consistently over the longer term. No surprises, dividend cut does look highly unlikely. And in the previous recession, well, they actually maintained the dividend. They didn't increase it, but they also didn't cut it. They had above average growth at plus 2%. This is one of the few stocks we've reviewed on this channel that has had one of the best returns during the last recession, negative 12, which is significantly lower than the S&P's negative 55. And no surprises, as we already mentioned, double-digit increases to their dividend very consistently over the longer term. And we can see they have been increasing those dividends for the last 12. We then move on to dividend yield theory. Well, in actual fact, we do see reasonable / slight undervaluation, 0.6 versus 0.55, 29.8 versus 33.2. When we look again, no surprises, financials much lower. When we talk about the free cash flow payout, again, a very similar trend, pretty much below 30% every single year. When we look at the free cash flow per share, again, very consistent increases over the longer term. Trend is expected to continue upwards over the next 12. Again, sales growth, we do get that COVID drop. Otherwise, for both Visa and MasterCard, majority of the last 10 years, we are seeing double-digit increases to their top line, and very similar, nearly tripled their top line over the last 10 years. Both very good companies in the fact that not only do they give a double-digit increase to their dividend, but as we can clearly see here, they have been doing a lot of share buybacks pretty much every single year. We then move on to the ROIC. Again, nothing really much to be said other than this is an incredibly high quality company, and you can just see that straight away by looking at all of these metrics. Not only are they much higher than the minimums we want to see, but they are consistent, and if not over the longer term, they are increasing. And again, no surprises, both companies have phenomenal balance sheets. 0.47 for MasterCard, 0.45 expected over the next 12 months. Even when it comes to the valuation, they are both very similar on the margin of safety. At 10% a buy at 477, at 15% a buy at 451. Not quite at that 20% level, and again somewhere around the 20 to 25%, so 424 between that and $400 does look like a very strong buy. Again, you may consider this is impossible, but if we do take a look at earnings, historically there has been a lot of opportunity, a lot of market overreaction in many stocks, so that is something why we are keeping our eyes open. But as we said, right now 15% MOS level, and very similarly 19% upside forecasted by Wall Street at the current price over the next 12 months. The next one we're looking at is Abbvie. Now this is one that we already hold, so this will just be an addition to the portfolio currently, and we can see another double buy rating with the hold from Quant. This is currently trading in the upper end of the 52-week range, a nice forward yield of 3.64% and a forward P just above 15. Over the last 12 months, well, very nice, up 26%. Over the last 10 years, again, outperformer of the S&P, up 210%. Dividend safety score, well, 80, and the more recent increase was October last year. Nice to note it was above that 4% inflation rate that we do target on the channel. And again, reaffirmed a few months ago, dividend cut for this company does look to be unlikely. Then when we move on to their dividend growth, as we said, above inflation last October, high single digit over the last 5 years. Nice to note, double digit increase over the last 14, and they are also a dividend king, 52 years of consecutive increases with 100 years of paying a dividend without a reduction. When we take a look at dividend yield theory, we can see here a sign of overvaluation with both the yield below the 5-year average and the forward P above the 5 years 9.9. When we take a look though, it is marginally lower than healthcare, which is sitting at 16.3. When we take a look at the free cash flow payout, well, below 50%, so we bring this lower when we're industry specific for biotechs, and it's been below 50% pretty much every single year, or the majority, expected to go marginally higher over the next 12 months. No worries there whatsoever with that dividend and those increases. In terms of free cash flow, well, increases over the longer term, although we should point out anticipated to drop into 2024 to around 1140. Then we move on to the sales growth. Well, important to understand, over the longer term, it has performed very well, much better than our 3 to 7%, although in 2023, we did see a drop to their top line for the full year, around negative 6%. Nonetheless, having said that, we do note it has increased more than double over the last 10 years, 20 to 54 billion. In terms of shares though, what we will say, unlike the first two, you would have had your position diluted over the longer term as they have increased from 1.61 to 1.77 billion. In terms of ROIC, well, above 25% for biotech, so it is much higher than the 10 we see for the other companies. Pretty much straddling around that year on year, so no massive worries. 24% in the more recent year, and always nice to see with these companies very strong margins both on the operating side as well as the free cash flow. And in fact, the free cash flow has increased over the longer term. In the low 40s is a very strong indicator of a high quality company. In terms of the net debt to EBITDA, something we would like to see below 1.5 for biotechs. It has been above that in 23, expected to go even higher over the next 12 months, something we would say just to keep an eye on, but overall no red flag indicators. And more importantly, when we do look at the valuation, right now we do see the intrinsic value at $200, so there is already a nice margin of safety. 10% will a buy at 180, 15% around 170, so right now at this price we do see a 15% MOS, but as always between 20 to 25%, we are talking about $150 to $160 will be a great opportunity to add, again, not only if there is a dip, but if we believe it is more of a market overreaction than something fundamentally wrong with the business. In terms of Wall Street, they see upside of 9% currently. Again, that is why we are waiting. We don't believe right now there is a ton of upside, hence why we do hope for a small dip. We then move on to what we see has the most upside in the Mag 7. It is Alphabet, currently now a double buy rating with a hold. In fact, it has the lowest forward PE of the Mag 7 at 24.5. It does have a yield, so it is a dividend paying company, but it is fairly minimal at the moment. And we can see it is trading towards the upper end of the 52-week range, up 56% over the last 12 months. Over the last 10 years, again, another significant outperformer of the S&P. Now, when we talk about this company, dividend does look to be safe, although they have just started to pay a dividend just over the last year. We can see again, dividend cut unlikely, makes complete sense. And when we take a look at dividend yield theory, although it has just started to pay a dividend, the more useful information to note here is that the forward PE isn't too far off the 5-year average, which would indicate reasonable valuation. When we do look though, no surprises, a lot higher than the communications sector PE. In terms of free cash flow payout, well, given they've just started to pay and looking around 12%, we would be shocked if we don't see some very aggressive increases to their dividend. And when we look at the free cash flow, this is what we want to see and pretty much what we have seen over the last few companies today and expected to continue over the next 12 months. In terms of sales growth, well, double digit every single year other than 2023 on a trailing 12 month at 12% still looks very strong. So hopefully we can expect that trend to continue for the foreseeable future. No surprises, very strong growth to their top line. In fact, it has more than quadrupled over the last 10 years. And what we have started to see over the last few years is this company doing those share buybacks, returning that excess cash. Hopefully they can continue this alongside some very nice increases to the dividend. And then taking a look at the ROIC, well, not only increasing over longer term, but very strong numbers in the high 20s over the last 3 years. 30% on a trailing 12-month basis does look very good as well. We get to note here operating efficiency on the operating margin, as well as free cash flow margin increasing over the longer period. Finally, net debt to EBITDA, 0 across the board. Won't even take them 1 day to pay off all of their debt net of cash on hand over the last 10 years and expected over the next year. Now, in terms of our valuation, the way we got to $188 was, if you have seen our deeper dives, using the DCF model. Now we can use 3 different rates, a low, medium and high. At that 10%, which we have gone for a low, why we deem it to be a low, in fact, that is lower than the average of 24% and lower than the recent year of 16%. But you can also use the medium rate of 15%. If we were to use that, as we can see here, that is $264, which would indicate 48% upside. As always though, with any of our episodes, you can grab a copy of this model in the pinned comment below, run your own numbers as well, whether it's for Alphabet or any others. Now, today's episode, we want to be really conservative here, so with that 10%, again, you could use any rate and justify it. We do see an intrinsic value at $188, which would indicate a margin of safety at 10%, a buy at $169, at 15% around $160, and 20% around $150. Now, for those who do believe 10% is sufficient because it does have a wide moat, good financial metrics, as well as the forward guidance, then you would be looking around $169. And honestly, I do believe that is a very good value to get if we do see some overreaction. With Wall Street, though, they do see some nice upside, 23%. Their upgraded price target to $220 for this stock. We then move on to one that isn't talked about too much. It is Chevron, the oil company. We have a strong buy from Quant, which is fairly rare, a double buy from the other 2 analysts. It is trading in the upper end of the 52-week range, a nice forward yield of 4.19, and we also get to see a forward P of just over 12. Over the last 12 months, not the greatest performance, down 3%. Over the last 10 years, again, not the greatest either at plus 19, but it will be at which point you have bought that. For example, if you did buy the COVID dip, it was sitting at around $60. In terms of the dividend safety, well, 90, very safe, and they did have a nice increase this year. In fact, 7.9% in February 24. Again, no surprises, dividend cut is highly unlikely, reaffirmed not too long ago. And in the last recession, in all fairness, they increased the dividend, and even though they had negative 43% sales, they still significantly outperformed the S&P, negative 34%. On top of all of that, they increased the dividend at a very nice rate, as we mentioned, 7.9 this year, 6% on average over the last 5, and 7% over the last 20. Not only are they a dividend aristocrat, increasing the dividend for 25 years and more, they've been paying a dividend for the last 112 without a reduction. In terms of dividend yield theory, well, we do get a reasonable valuation. The yield as well as the forward P aren't dissimilar from the 5-year average, and we also know, again, not too dissimilar from the energy sector at 12.7. When we talk about the free cash flow payout, 40% is the target for oil producers, and that is pretty much where it has been over the last few years, straddling around a few percentage points higher or lower, 52% anticipated over the next 12 months. When we look at the free cash flow, bear in mind a few things. It is a very cyclical company, and whilst it has increased over longer term, we do note some very large dips across the year on year. 2024 expected to be a nice increase from 2023. Same to be said for the sales, as we can clearly see. In fact, 6 of the last 10 years have been negative. No surprises again. And then looking at the revenue from 2014 to 2023, it hasn't moved massively year on year. There have, however, been massive fluctuations. In terms of shares outstanding, very minimal to talk about. A few share buybacks here, a few share issuances as well. In terms of ROIC, well, the last 3 years have been fairly decent, but again, the cyclicality point does really show across nearly every single metric, whether that's the margins, free cash flow margin. One thing we would like to note though, the net debt to EBITDA does look very strong. It is below 1.5 in 2023, expected to be there or thereabouts again over the next 12 months. So no worries with the dividend safety, as well as we just mentioned, balance sheet does look nice. Intrinsic value then $184, current price $155. We get a margin of safety at 10%, indicating a buy at 166, at 15% around 156. So again, that is what you are looking at in today's price. And we want to see something around 20 to 25. So we would be looking for a price around $137 to $147 to add this as well. Right now though, with a 15% margin of safety, Wall Street do see some nice upside at 19%, 185 price target, and at the same time you are collecting a nice dividend which has typically increased above inflation. We then move on to Metronic, where we get a double buy with a hold from Quant. This is trading in the mid to lower end of the 52-week range, a yield of 3.6% and a forward P just above 14. Over the last year, well, down 11%. over the last 10 years, as we can see, it has been a bit of a roller coaster. All-time highs sitting around $134, pretty much double the current trading price. We then look at dividend safety. Nice to note, highest score obtainable, although we do want to point out a very small increase to their dividend just in May this year. When we talk about dividend safety though, with this company, dividend cut is highly unlikely. In terms of the last recession, well, they did increase the dividend, they did have above average growth, however they pretty much had an S&P return at negative 56%. Over the last 5 years though, they have had a nice dividend increase at 7% year on year, and over the last 20, double digit, which is one of the reasons why it was disappointing to see that increase this May. What we do want to note, not only are they a dividend aristocrat, but they are 4 years away from becoming a dividend king, something that we do believe is inevitable for Metronic. When we look at the dividend yield theory, then what we can see here, double undervaluation, in fact a serious undervaluation signal, with both the yield being significantly higher than the 5-year average and the forward P being significantly lower than the 5-year rolling. And in terms of healthcare, well, it does sit higher at 16.3. When we look at the free cash flow payout, whilst we want to see below 60%, not something we've seen over the last 2 years, although we do see expected to drop down, which is nice to note, 58% over the next 12 months, so we should be expecting a nicer increase to the dividend next year. Free cash flow per share, just bear in mind it is very inconsistent on a year-on-year basis, expected to increase further though over the next 12 months. And when we talk about sales, again, don't expect some massive increases. This isn't a fast-growing company or a tech company. On average though, overall around 3 to 7%, although we do note 2 of the last years negative-wise. In terms of their total sales though, we do see it grow, but again, do bear in mind the type of company. This will typically just grow in line with inflation. Over the longer term though, what we do know, even though we did see a large share issuance in 2015 to 2016, they have done some share buybacks over the last 10 years, but again, looking fairly trivial. In terms of ROIC, well, it is straddling around the 10% we want to see, around 7 to 9% just over the last few years. And more importantly, when we do look at the margins, both operating and free cash flow, very, very strong, above the minimums and very consistent as well. Finally, look at the net debt to EBITDA. There will be no surprises given we saw the very safe dividend score, but 1.9 out of 3, 1.82 is what expected over the next 12 months. Just goes to show balance sheet does look very healthy. Dividend, whilst we did see a smaller increase this year, should return to some normality over the next few years. Then we get into the valuation of $98. Again, current price at $77.50 does mean there should be a nice margin of safety. At 10%, a buy at $88. At 15%, around $83. And at 20%, pretty much what you are looking at in today's market. Now, in terms of looking at a larger MOS, at that 15%, you would be looking at around $73.50. At 30%, around $68, $69. Now, it doesn't feel like too long ago that we did see that price for Metronic. And again, if we do see an overreaction, which could be very probable for a company like Metronic, which has had some years of fluctuations, then it could be a very good time to consider for the portfolio. We also noticed that Wall Street do have a nice upside target at 25%. Their price $96.80 as well, indicating a consideration for the portfolio. As always, if you enjoyed today's episode, smash that like button, hit that subscribe and bell button, let us know your thoughts below, and we'll see you all on the next one.